Yo, what's up guys? Nate the Robber here. I want to show you 3 dividend stocks I actually just picked up, and most of these were actually in my Moomoo portfolio where once I buy a stock in this account, I can never sell it for the rest of my life. And this account actually just went over $10,000, but a lot of that is cash right now and we're earning interest on it. We get a 4.6 APY with Moomoo, but anyway, let's go ahead and get straight into the video because I picked up 3 dividend stocks today. I added on to the positions and I want to go ahead and share the news with you guys because most people can, in their own portfolios, sell a stock and kind of forget about it if it's like a big loss. But in this account, once I buy a stock in here, I'm literally never allowed to sell it for the rest of my life. And that's like this stock down here. We have Perion Network. We're down 66% on them. But let's go ahead and get straight into the first stock I want to share with you that I bought today. Now, this one, you got to hear me out on this one because this one will impress you financially. And I have some news I want to share about you about this stock. So I actually have been adding to my Disney position for the past couple of weeks here. As you can see, every time I buy a stock, you can see exactly where I bought it. And I bought a share of them today at $96, which is the highest I ever bought a share for. But anyway, here's why I'm so bullish on Disney. So first off, they just have an incredible valuation. So let's go ahead and look at this right here. So if we actually look at their price to free cash flow ratio, Disney is trading at a 22 times free cash flow and their forward PE ratio is a 19.19. But to really visualize this, I'm going to go ahead and show you, here's their EPS. So as we know, it fell like crazy from 2019, went from, $6 down to $2. But here we are right now. We're almost back to there, In the next 12 months, we're going to get $5.04 of EPS. That's where they have this forward PE ratio from. If you do 19 times 5, that will get you the current stock price. And look at the free cash flow per share growth as well. This one's another one that tanked. It went, from $6 all the way down to $1, but now it's about to be the highest since the dip at $4.72 next, which is pretty crazy. They make like $8 to $9 billion of free cash flow a year, which is really impressive. Like, look at that. Their total sales keep on going up, which is a great sign. The return on invested capital, again, is getting hit, but, it's getting better. It's definitely getting better. So that's what I really like about Disney. And this company also is doing a recent price increase with their Disney Plus subscription. So they have 159 million premium subscribers, and it could be any of the ad tier subscriptions. And check this out. Here's the new price starting October 17th. So this has not hit the financials yet. Check this out. This is the monthly price. So Disney's going to get $2 more per month for every subscriber. Check this out right here. So Disney Plus with ads, it's going to go from $8 to $10. And if you want to get the whole package, Disney Plus ad-free plus Hulu plus live TV and ESPN Plus, which might be a good deal. I don't know if it is, but it's going from $90 to $96 a month. So, it's definitely a meaningful price increase where I think Disney's about to crank out a lot of free cash flow. And if we look at Netflix stock, they are actually at an all-time high today because they reported earnings and they said they got away with, raising prices of their subscription and customers didn't really unsubscribe. They were the most profitable they ever been on that quarter. And check this out. It's the same for Disney right now because they're the most profitable they've ever been. And I say that because they actually just went profitable. So our combined DTC streaming businesses, which is all this, ESPN, Hulu, Disney Plus, all that, were profitable in Q3 ahead of our guidance, and we remain on track for that profitability to improve in Q4. So this is what's crazy. They keep expecting to be profitable on this metric. So their combined streaming businesses were actually profitable. We can see their operating income right here. And I think with these recent price increases that are coming in October, I think that this is just going to explode in profitability. They're going to be the next Netflix, even though, they're way smaller and don't have that much market share compared to them. I think there's definitely some room for growth there. So that's kind of why I like Disney. Even though they have a really low dividend yield, I think they're going to grow it over time because they just rose their dividend from the previous quarter. All right, so yeah, that was Disney stock. We currently own 13 shares. We're up 5% on Disney. But now let's go ahead and look at the next dividend stock. And then one I picked up next was actually ticker symbol Cube or Cubesmart. This one has a pretty high dividend yield. And if we look at this stock over the past couple days here, it's actually fallen quite a bit. It went from, 54, 53, all the way today. Today was actually pretty crazy. And it went lower even after I bought a share. It's actually at $48 right now. And this one actually has a really high dividend yield. And that's because this one is a real estate investment trust. And if you don't know, these companies by law have to pay out most of their income in the form of dividends. So that 4.2% dividend yield is actually completely normal and sustainable for this company. Now, if we look at the RSI at the bottom here, they're actually oversold at a 27 RSI, one of like the lowest it's been in a long time. And it's actually a really big company. They have a $11 billion market cap. And I'll quickly show you the numbers on this. So they made $170 million in the most recent quarter, up 6% year over year. That's the number we look at for the dividend payout ratio. And their dividend only cost $115 million. So they actually have quite a bit of room to raise the dividend. And it may seem like a high payout ratio, but again, this is a REIT and it's actually normal for them to have that really high dividend yield. And they're actually really close to all-time highs as well if you look at it on the dividend reinvested chart, which is pretty cool because it's fair to look at the dividend reinvested chart. But let me actually show you a few slides from their investor presentation, and it's actually really impressive. All right, guys, so here's Cubesmart's most recent investor presentation. This one's from September 2024, so it's the most up-to-date. And check this out. Here are a few highlights. You know, they have nearly 1,500 properties, and they're also BBB rated from S&P Global and Moody's BBB. So there's a lot of safety behind that, you know, being rated from S&P Global. And also, I just love this industry, this self-storage industry. We can kind of see the returns versus the REIT index. But check this out. Here's why they do so good. It's because they have really high margins, you know, super low expenses. It's literally just 4 walls and a sheet metal door, low CapEx requirements, and also they're short-term leased. So check this out. The month-to-month leases allows for rapid repricing in response to changing economic conditions. What that means is if inflation comes back, they can capture that inflation that month. They can raise prices that month, while other, you know, longer triple net leases can't really capture that inflation and the inflation might go away. So that's why the self-storage industry did so good in 2021 and 2022. They were easily able to capture that inflation and just have crazy margins because most of their stores are profitable with a super low 20% occupancy rate. That's when they're profitable. So that's what's really cool about self-storage. You know, they're in the most quality markets, which is a really good sign. But here's the most important slide from the investor presentation. Here's what separates them from the competition. It's because of the average 3-mile population density. Look at this. Public storage and extra space storage are 2 other bigger competitors, bigger market cap, but the average 3-mile population density is way higher here, 50% higher. And that's really the market you want to be in for self-storage when there's a ton of people in one area. And also look at the average 3-mile median household income. It's also the highest out of all 4 of these. NSA is one that really focuses on like the urban areas where not a lot of people are, but that's all right. I actually used to own that company. But also here's another really important slide. They have such a high 3-mile population density because a ton of their portfolio is in New York, which is really the market to be in because that's where a bunch of people are. And so, yeah, check this out. Our New York City stores make up the largest portfolio, Class A properties, and they actually create vibrant billboards for our brand. You know, look how nice that property looks. You know, if I drove by that, you know, I couldn't help but, you know, look at that. And also, this is kind of a cool thing that they might have did. So check this out. Supply is waning, so competition is going away due to recent legislative changes removing self-storage eligibility from the ICAP tax incentive program. This is for the New York State. So their competition in New York, which is their biggest market, is going away because of the tax incentives are going away. So they got the tax incentives, Cubesmart did, and now other people can't. So that's kind of a cool thing. So the competition is going away in their largest market. So that's kind of a few reasons why I really like this one over a lot of the other self-storage names. You know, robust portfolio growth. You can see their total properties have gone up every quarter, and they have a lot of managed stores. So look at their managed stores. It keeps going up, and all their managed stores, they collect a very high profitable fee off them. They get a fee every single month or every single year, something like that, from all these different managed stores. So that's what's really cool. And they, of course, are growing their wholly owned stores as well. It's been flat for a couple quarters, but that's all right. You know, I really like them. Let's actually see how much management fee they're getting. Oh, yeah, here's a little bit about their financial condition. Net debt to EBITDA is 4.1x. Realty income is around a 5, so they're lower leverage than realty income, but that's not a completely fair comparison. So debt to gross assets at 38%, EBITDA coverage 7.8. So, yeah, these are all very good metrics. And, oh, yeah, proven access to capital. They've risen money through all these different ways, prefer equity, bank debt, credit facility. These are kind of, you know, some more irrelevant facts. But yeah, that's what I really like about Cubesmart. Oh yeah, efficient expense management. So look at that. Here's their competition. The peer average is EXR, PSA, and NSA, you know, the main competition. Look at their expense growth. It's been very small compared to what the competition has had. They've seen 5% expense growth, 6%, when they only had 2.3%. So again, this one, in my opinion, is a quality REIT that I have no problem holding on forever. And that's why I just picked up another share, you know. I really focus on the quantity of shares more than anything else. So yeah, that's Cubesmart. All right, guys, so for the last and final stock that I will never sell for the rest of my life that I just bought is actually ticker symbol NKE or Nike. So we're down on our position right now, but I actually just picked up a share on today and the previous trading day before that. So we've kind of been buying the dip on Nike, even though I would have loved to buy more shares down here at the $72 level. Again, I don't focus on price so much. I want to get exposure and more quantity of shares to these high quality company names because in 5 to 10 years, it won't really matter if I picked it up at 70 or 80 because it'll be doubled. Or, not personalized advice, nothing in this video is financial advice, but I think Nike's going to do pretty good long term, and it's just simple math. I actually want to show you why, because I didn't actually know they were trading this cheap. So if we actually go to Nike right now, if we go to their current free cash flow statistics, I'll actually do the exact math for you. The free cash flow was $7.2 billion. I like to look at the free cash flow per share metric because it includes stock-based comp and all those other expenses like employee options, whatever. It was $4.84. So the current stock price of Nike is $81.48. So we want to do $81.48 divided by the free cash flow per share of $4.84. And that will actually, or $4.84, yeah, and that'll actually give us a multiple of 16.8. So Nike is actually trading at 17 times free cash flow. And this company also has more cash than debt. They're also doing some share buybacks. So yeah, shares change year over year. They've actually bought back 2.55% of the entire company year over year. And that's why the free cash flow yield is so high, because the free cash flow as well, it's a 5.94% free cash flow yield. I mean, that's really great. Their dividend yield's a 1.82%, and they have 19 years of dividend growth. So in like 5 years, they're going to be a dividend aristocrat. They're also in the S&P 500. They're a huge company, $121 billion company. And, I think that they can even grow to a bigger market cap, because look at that. They're a $121 billion company, and they made $7 billion of free cash flow. As we already know, the price to free cash flow ratio, it's right here. Look at that. The market cap divided by free cash flow is 16.82. And look, that aligns with our math of 16.83. So we were pretty much spot on. The trailing 12 months PE ratio is a 23, but their net income is expected to go down. That's why their forward PE ratio is a 28, but I don't know how much it's going to go down. So we can see their 5-year average PE ratio is a 31. It's below it right now at 28, but their dividend yield is, I think it's at an all-time high. It's at 1.82%. That's because as the stock price goes down, the yield goes up. So they're at a 1.82% dividend yield. Simply Safe Dividend actually keeps Nike at a 99 safety score. So basically no chance of the dividend being cut because of, I'm guessing, for how much free cash flow and net income they make, because they're a profitable company. And if we compare it from 2019, so here's their shares outstanding, they keep on buying back their own shares. But if we just go to their EPS, where's their earnings per share? Yeah, right here. Look, so in 2019, Nike stock price is lower than it was in 2019. And look at this. In 2019, it was $250, $249. They're expected to be $2.88. So they're expected to be above the 2019 level prices. But this growth right here, or this declining growth, is not good for the stock price. So yeah, that's kind of my thoughts on them. It's not terrible. It's not as worse as it could be. They're keeping up their margins, their free cash flow margin. I'll actually show you some more about their margins right here. So if we actually head back here to the Moomoo app, I want to show you something very interesting. Remember, if you want to download this app, I have an affiliate link in the description. You can get the 4.6% APY, completely for free. There's no $5 a month, kind of like Robinhood. Oh yeah, here's the PE ratio. It's a 23. We kind of looked at that. But here's the most important part I actually want to share with you. It's that they're keeping their margins up. So look at this. Here's their gross margin. It's up 3% year over year. It's this one in the very top right is what we're looking at. Their operating margin's up 5%. Their EBIT margin, their net margin, even though their net income went down, their net income margin went up 8% to 10.6%. That's great. Their EBITDA margin was great, and 13.5%, up 4% year over year. So yeah, that's kind of my thoughts on Nike. They have more cash than debt right now. Nike still has a return on invested capital of 20%, free cash flow to sales ratio of 14%. So if you go and spend $100 with Nike, if you go spend $100 at Nike, $14.42 of that is pure free cash flow for Nike. And that's kind of why I really like Nike. They're getting better. They just got a new CEO. They just changed one of their management. Who'd they change? Like the the CFO or something like that. Oh yeah, Nike extends deal with the NBA and WNBA for another 12 years. That the stock actually went up, 0.5% after hours. I think the stock's actually going to go up more probably tomorrow off that news. I didn't think the market really reacted to it, but that's some really good news for Nike. So for all those reasons, those were the 3 stocks, dividend stocks I bought in my Moomoo account. Let me know what your thoughts on this is in the comments. Of course, I can never sell these stocks either. So if you subscribe and come back to my channel in a year, 2 years, I will still own all these same stocks. You can go watch my old video from a year ago. I started making portfolio updates about this one a year ago. I've not sold any stock. I've kept all the same ones. You can check it back and watch it. But yeah, thank you all for watching. I'll see you on the next video.